NeuPath is Canada's largest provider of health services targeting chronic pain, musculoskeletal injuries, sports injuries, and concussions. The company just reported their Q1 results, and CEO Joel Walewicz is here to present and discuss the results and company outlook. I'm Martin Gago with Market Radius Research. Please remember, this is neither recommendation nor investment advice. We're here to learn about the company. Joe, good to have you back, and congrats on a solid quarter. How are things going?
Excellent. Thank you. And thanks everyone for joining me online today. It's been a few months since we last spoke, so it'll be good, for those of you who know the name, you'll get a good update. And for those of you who haven't heard us before, hopefully you'll learn more about us today. Joe Walewicz, I'm the CEO of NeuPath Health. I took over as CEO almost 3 years ago, but I was on the board since our RTO in 2020. So I've been involved with the company for some time, almost 5 years now, and almost 3 years running the operation. So in terms of the company, obviously, we're going to present some forward-looking statements. So you should all be aware of that and have a look at our AIF or any all the risk factors so you understand what we'll be talking about today. We also do use some non-IFRS measures, such as adjusted EBITDA. Happy to discuss those with you in the question and answer period as well. And then let me just give you a quick overview for those of you who are unfamiliar with the story. We are Canada's leader, as we mentioned, in pain treatment, but we are a private provider of public health operating a growing network of chronic pain treatment facilities. And a couple things I want to say there. As a private provider of public health, we all our clinics in Ontario and Alberta are largely funded under the government umbrella. So if, as a patient suffering from chronic pain, when you get referred into us, you are getting reimbursed under the government insurance plans, largely for all the procedures that we do. In terms of the market, obviously, we are addressing a very large need, and this is a very fast-growing market. I imagine of the people on here, I see about 24 participants already. All of you know someone, either yourself or someone close to you, who is suffering or has suffered from chronic pain. It's a terrible, debilitating thing. It can be very confusing. There's lots of great articles in the media about people suffering. So we are unfortunately addressing a very large group of people, but I think that we're an important part of the treatment paradigm for these people who are suffering. Lots of organic and inorganic growth opportunities. I'll go through that in a little bit. We definitely have not even begun to scratch the surface of this market. These are regulated medical facilities. So sometimes people talk about clinics. What we're really running is regulated medical facilities. So these are when our facilities in Alberta or in Ontario, they're registered with the Alberta Health, the college in Alberta, or in Ontario with the College of Physician Surgeons of Ontario, that regularly inspect and look at our clinics, evaluate all the paperwork related to it, evaluate our doctors and our various charting, they'll do chart audits for our doctors, et cetera. So it is a regulated business. We are well positioned for changing health policy. One of the things I mention frequently to investors is that what we do in our clinics is done in hospital. This is this idea that things that used to be done in the hospital are now done out of hospital in the community is a big part of medicine today. And a lot of what you hear, whether it's in Ontario talking about private surgery being funded by the government, whether it's if you go into Toronto and you have a hernia repair, you might go to the Shouldice Clinic. That's a private clinic that's run, but the government reimburses for those procedures. And what you're seeing is that for many procedures, they just don't need to be done in hospital. And things that we used to do in hospital are not being done there, whether it's cataract surgery, whether it's, I mentioned hernia repair, and then, of course, interventional pain medicine, which we do. So we think this is all part of that broader theme of government saying, what does a hospital need to do, and what can we do in the community closer to where people are without using overburdening the overhead of the hospital. Since we've taken over, we've had a very successful turnaround of this business, and you can see, I'll show you the numbers in a little bit. And that's because our proven team and our systems are there to make sure this business runs smoothly and efficiently on behalf of our patients and our physicians and our staff. We had 200,000 patient visits last year. I had 154 medical professionals, including approximately 100 doctors on our roster that practice with us. We have 15,000 physicians that rely on us when they have patients that are suffering, that they know that they can send their patients over to us. We have low turnover rates, high patient satisfaction. We use a bunch of different specialists in all our clinics. So when people say, what kind of doctors work for you? We got physiatrists and anesthesiologists and orthopedic surgeons. We have general practitioners who are specially trained in interventional medicine, sports medicine doctors, physiotherapists, and other allied health. And that allows us to take care of such a broad range of patients and also take care of them in different ways. As a business, we are currently in Ontario, from Ottawa to Windsor and almost everywhere in between. There's still, despite our large presence in Ontario, we're still in a few markets that we're not in yet. We're not in Northern Ontario, we're not in Kingston, not in Niagara. So those are places certainly that are top of mind as I continue to think of our Ontario rollout. In Alberta, we address about 38% of the market. In Edmonton and Red Deer, we're looking to, certainly everyone knows what city is missing there, and we're certainly, that's a high priority as we look at Calgary and other markets within the Alberta market. So we are definitely planning to expand and continue to address these two markets more fully, as well as looking at other provinces and areas in Canada. When I spoke to you last October, we were still, improving, and we've continued to improve since I last spoke to you. Last year, we did almost 73 million in revenues, up 8%, double-digit growth in the fourth quarter. In 2024, we were up, our EBITDA was up to 3.8 million. It's grown 29% over the last 2 years, growing faster than my top line. So we're very excited about what's happening there. In fact, in Q1, if you just notice, we reported last week, I haven't put that in here, but we had 1.3 million in adjusted EBITDA, up 49% year over year in Q1, and revenues up 11% year over year. So all of these changes we're making under the hood are starting to yield results, and you're seeing that in our numbers. One of the key things that I talked about a lot to people is this whole change in footprint. This business, when I took over in 2022, we had over 93,000 square feet in terms of leased space. We are now, by the end of this year, we'll be just under 70%. And so that big reduction in real estate, that's about 30,000 square feet that we've taken out of the system. And when you put 25 to 30,000 square feet and you multiply that by $30 a square foot, you end up with a very large amount of cash flow. So what you're seeing in our numbers now is in part driven by these real estate changes that we've made. And so when you look at our revenues growing at double digit and you look at our real estate dropping by 26%, you start to see the gap, and you start to see the EBITDA grow, and you start to see the margins improve. And that's all driven. There's other operational improvements. We're definitely looking at our medical expenses. We're looking at our staffing costs. But this is definitely one of the biggest changes we've made. And some of it's fortuitous. We have a lot of leases that come up in the last 2 years. And so as you see those leases get renewed and we return space to landlords, you're seeing this managed. And I won't go into a long story about why we have so much real estate, but there was history of the business that 10 years ago, there were a lot of leases signed for businesses that are no longer part of NeuPath and have since been divested. And so it's really more right sizing rather than really forcing doctors to work in a closet versus a gymnasium. So that's kind of one of the big things as well. Just getting the balance sheet right. That's been the other thing we've really focused on. So when I took over, we had 1.5 million in cash and 6.8 million in debt. As you can see, we actually just signed a new $6.5 million facility with National Bank. So that third bar is as of the end of Q1, so March 31 of this year. And we also increased our cash level. So you see that we're at 4.4. So our net debt is now at 2.1 as of the end of March. So from December of 22, the net debt of 5.3 million down to 2.1. So this is a big change. And so when now you look at it, you look at adjusted EBITDA that was 3.2 in 2023. The last trailing 12 months as of the end of March was 4.2. So you're now talking about adjusted EBITDA that is, basically 2x, or you could say my net debt is half of my adjusted EBITDA for the last 12 months. So in terms of, a couple things I just want to mention there, certainly from an adjusted EBITDA perspective, we fully disclose all the details of that in our financial statement. So if you have questions about adjustments that are in there or things that are not, you can certainly have a look. One thing I just wanted to highlight is you see at the bottom, the IFRS lease debt. So for those of you who are interested or knowledgeable about this, IFRS, we include about half of our rent in our expenses, and half of it is capitalized. And so when you look at our cash flow statement, you can look at directly the lease payments. You take that in and you back that out of our adjusted EBITDA, and that gives you kind of an approximate, what we internally would call an EBITDAR, like an EBITDA after rent, kind of thing. And that gives you a sense of kind of what we look at from an operational point of view. But all of our details, as I said, from rent to adjustments, those are all in the financial statements, and I'm more than happy to answer any questions you might have. If you take that piece out and you say, last year we did 3.8 million in adjusted EBITDA, and we had about 1.6, 1.7 million in that rent expense. You're about 2.1 million in kind of what I would call kind of a proxy for free cash flow before the CapEx and interest payments. So in terms of opportunities for growth, first, as you can see, we report to you every quarter on capacity utilization, definitely looking at how we better use our facilities. That's how we one is to bring on new doctors. How do I bring on new doctors and let them better use? I have some clinics that are running above capacity, above 100%, and some that are below. So how do I make sure that I have those facilities full? And so you bring on new physicians. You add new services, including, public and private pay. So we added a new service I'll talk about in a second. And, that gives us, an ability to grow kind of outside of our core interventional pain medicine piece that we provide for the government. And then finally, just looking at other ways of expanding in terms of exploring new partnership opportunities. In Red Deer, we signed a partnership with a group, an orthopedic surgery group there a few years back, and we built a brand new clinic with them, and we each own it jointly 50-50. It's my fastest growing clinic. It's serving the Red Deer community very well. And what's happened there is just by having a partnership with local doctors, we were able to quickly get up and running on a very successful interventional facility. Building out a network through acquisition. Well, our Red Deer didn't happen without our acquisition of Edmonton-based HealthPoint. So by buying in Alberta, we were able to expand into Red Deer, and hopefully there will be some other provinces where we may buy a beachhead and expand throughout the province using that core. And finally, there's adjacent markets. Look, if I told you I was the biggest in Canada, I'm still in Ontario, maybe 20% of the market. Alberta, much less than 20%. And I'm not even in any of the other markets. So if you think of it from a Canada-wide point of view, we are nowhere near saturated in the chronic pain space. However, if I was to say, okay, well, I'm all done with pain, I'm serving all the patients I need, there's a lot of overlapping specialties, whether it's interventional radiology or radiology, or orthopedics. If a patient's candidate for pain, for interventional pain, they probably need some images done. If they're a candidate for surgery, they may go in, the doctor says, well, I actually can't do anything for you now. Why don't you go see the pain treatment facility, right? And so there's a lot of, if I were to fully saturate all the Canadian markets in interventional pain, which I'm nowhere near, certainly we view orthopedics and radiology as high overlapping areas of high interest to us that would provide cross referral and better service to our patients. I also mentioned kind of out of hospital surgery. I know it's high topical right now, but we don't do any of that right now. However, if you look at some of our facilities, our fluoroscopy suites, if you were to make those, if you were to put a surgical lamp on the ceiling, they could theoretically be a surgery room with better, we'd have to change the HVAC, but ultimately we could do surgery in some of our clinics if we wanted to. We don't yet see the business model there yet, but it's certainly something that if I'm exhausted all the other opportunities for growth, that's certainly something else we could be looking at as well. So we spent a lot of time thinking about, just that core part of attracting and retaining physicians. These are regulated treatment facilities. So if you're, these pieces over here on the left, these bullets here are really to say all the different pieces of the puzzle that we put together for physicians, that each one individually is not a selling feature, but when you package them all together, it suddenly becomes a really compelling reason for them to work with us. For example, you see in that picture, HealthPoint, our Edmonton facility. This is a facility with modern technologies. We have 3 new fluoroscopy suites. If you were to walk into our HealthPoint facility, you would think you were walking to a brand new, modern, almost hospital-like facility. It's a beautiful facility. And so when patients walk in there and they realize that they're getting funded largely from Alberta Health, this is a great thing for them to see, brand new facilities, but also for doctors. They walk in, they go, wow, you're going to take care of the paperwork with the government. You're going to provide me the latest technology. I've got a built-in referral network. For example, here at HealthPoint, I have an 18-month wait list. Imagine you're a new grad with $100,000 in debt, and you want to build a new physician practice instead of spending 2-3 years building that network, we've got a ready-made list of people for you to work on. We, of course, and then the bottom three are just the things that any network like ourselves would provide: HR, IT, and all the buildings, facility management, et cetera, that an operator like ourselves would provide. It really means that when doctors walk in, they can do what they do best, is deliver great care to patients, and we do everything else. We also are starting, I mentioned that we're starting to add new procedures to our facilities. Very excited to have announced a few weeks back that we're the launch partner for Contura. This is a European pharmaceutical company. They got Health Canada approval for this brand new product for osteoarthritis of the knee. We're really excited to be the first ones to be doing this in Canada because it's such a life-changing, potential life-changing therapeutic for patients. It's basically an injection into the knee where it incorporates into the tissue, and it's essentially it's a hydrogel that incorporates permanently into the tissue. So it's almost like putting a shock absorber or a bumper into the knee. And so what it means, that's the scientific part of it, or the technical description. The factual piece is that for a patient who may be on a 3-year wait list for a knee replacement, this could potentially eliminate or postpone the need for that. And so we're really excited because with Canada, with a lot of patients sitting around waiting for their knee replacement surgery, we think this could be a great option for some of them. And like I said, could potentially, if it's successful, may potentially eliminate that. We've already, I won't say how many patients we've done to date, but this has been a lot of interest in this program for Canada. And this is, unlike the rest of our procedures, this is private pay because the government, with a brand new product, they don't usually cover it. So we have people that are, basically reaching out to us and asking us, can you please do this for me? So we're pretty excited now. We've got 5 locations in Ontario doing this. We've got Alberta is starting in the next few weeks, and we'll be able to serve kind of east and west with this brand new product, and we're very excited. We think that being a first mover here as well will kind of provide some long-term benefit to us when patients are Googling and saying, arthrosis, where can I get arthrosamid? We think we'll be showing up there first. I told you kind of about what we do and, the financials, what we do. I want to talk a little bit about our capital structure just so you understand, because it's a really tight capital structure. We have 34% is institutional. By institutional, we have 2 major shareholders. That's 23%-ish is Bloom Burton, which is a Toronto-based investment bank that owns 23% of the company. I have almost 12% owned by Claret Investment Management in Montreal. They're a money manager, manages almost $3 billion in assets for high net worth individuals. And, outside of that, I can probably make about 5 to 8 phone calls and I can get up to about 80% of my shares. So we've got a very tightly held supportive group of investors. Myself personally, I've been buying whenever we are out of blackout, been buying. Now it's 600,000 shares that I've acquired. Our normal course issuer bid is now active. We put that in place in Q4. We've acquired 500,000 shares for cancellation as of the end of April. And, I think that the reason we do this is because I don't say we're undervalued, like as every CEO is going to say that. I know I'm undervalued because I can't actually buy a clinic for my multiple. So it's kind of one of these challenges, my burden, my cross to bear, is how do I buy stuff when I trade a lower multiple than the stuff that's for sale? So that's something we definitely try to address in terms of inexpensive bank financing, and that certainly will be how we build the business for the short term, is using our internal cash flows and our bank debt to help us grow. But as you can see on the bottom of the page, it's 12.8 million market cap as of yesterday. That's our trailing 12 months adjusted EBITDA 4.2 million, and as I mentioned, net debt of about 2.1 million. I want to talk just briefly here about some of the dilutive piece. I mean, of course, we have options and RSUs as any company our size would have. The warrants, we've now gotten rid of a few warrants in April from our prior broker for our offering 2 years ago. So all that we're left with is one block of warrants. It's one single investor. It's our insider. It's Bloom Burton, owns 4.48 million warrants, exercisable at 25 cents until next January. And that's the only kind of dilutive instrument outside of the normal course that you'd see. And so we, as a friendly investor who built the company from scratch and took us public, and is also an insider, that those are not going to just start dribbling out. those are part of the main block, and you will see them kind of, we think they're very supportive, and we wouldn't expect anything there. But certainly just wanted to note for people that there aren't like 20, 30, 40 people holding these warrants. It's one single holder of those warrants. All right, so in terms of myself, I'm now almost 30 years in healthcare. I started out a couple decades ago at a company called Pfizer. You may have heard of it. And then I went to Wall Street, and I was working at Lehman Brothers, and then I came back to Canada as an equity analyst covering Canadian healthcare for BMO CIBC. So spent the first 16 years mainly on the investment banking side as an equity analyst covering Canadian healthcare. And I decided to go back to the industry. A couple successful companies, Paladin Labs. That was a great success for Canadian investors. Probably some of you know them. Clementia Pharmaceuticals. We Nasdaq IPO. We raised 200 million, and then were sold for $1 billion in 2019. So when that was sold, that was when the nascent NeuPath asked me to join their board at that time and join the audit committee. Our Jeff Zaguris, our CFO, he's previously our controller. We promoted him to CFO in 21 on an interim basis, and he was doing such a great job. Asked him to stay on, so he's our full-time CFO. And then Stephen Lemieux recently rejoined. He was with the company at RTO as the CFO, then went off to 2 NASDAQ companies. I asked him to come back as a non-financial role, really help me on the business development side. So he joined as president as of May 1. And his role is really to help me both on, as we saw a lot of growth. There's a lot of empty spots on the Canadian map that I'd like to fill. And Stephen's experience, having done our first acquisition in Alberta, I think it's going to be great. One, as we look at expanding and integrating new businesses, and two, as we look at operational excellence. I think we saw in Q1, we were at 6.6% margin, adjusted EBITDA margin. I've said to investors, I said to Bloomberg a few weeks ago, I think our long-term number on a $75 million business is about 8 to 10%. And so Stephen is here to help me kind of optimize all the under the hood things beyond the real estate that I talked to you about, that I've been working on a lot over the last 2 years. So, Steve and I are going to drive those margins in as well, drive some of these many opportunities we have to grow the business, drive those deals to conclusion. So very excited to have him rejoin the team. So, for those of you, obviously remember I spoke in October to you, or may have seen me on other webcasts. We just reported a great year, up 10% in 2024. We were up 11% in Q1, just serving more patients. We have record adjusted EBITDA, 3.8 million. As you can see, trailing 12 months is now 4.2 after our Q1. So, great growth on the both the revenue and the adjusted EBITDA side. We're first ever in Canada to launch the arthrosamid. We now have our brand new credit facility with National Bank that we just closed at the end of March. And so that new credit facility is going to support our new growth initiatives. It's what a normal growth business would have. We have a credit line, we have a term debt, and we have an acquisition line. And as I mentioned earlier, our debt is about half, our net debt is about half of our adjusted EBITDA. Finally, we added to the executive leadership team, as I mentioned. So just summary takeaways. Look, this is I've been talking about the turnaround for 2 years now. You're seeing the fruits of that success. We have growing top line, as we have continuously throughout, but now we have improving margins and improving cash flows, and we're continuing to invest in that. Lots of opportunities for growth. There's no shortage of people, unfortunately, suffering from chronic pain. So we're going to try and help them out in all the ways that we can, with as many new procedures as we can bring into our clinics. We have great market share in our primary region. We're growing in Alberta, and we're going to continue to grow across the country. Would love to be in BC, looking at that very closely. Would love to be in Quebec. So we're definitely looking at new locations as well outside of our 2 core markets. I mentioned the alignment with government policy and really moving in hospital to out of hospital. And this team, we've said 2 years ago, it's a proven leadership team. Now I think I can show you the numbers, and I can say that we are delivering what we told we were going to do, and we continue to do so. And so a lot of this, all those tinkering under the hood, you're going to keep seeing over and over again. The real estate piece that I told you is by the end of the year we'll be down to 68,000 square feet. That doesn't show up till 26. So all that real estate footprint numbers, those are slowly dropping out over time, but the full effect of that is next year. So all these things, are slowly working through their way through the system. And so we'll continue. That's why I think when we said in Q1 results, we mentioned, we're very confident, in the continued growth of the business. And then finally, I do mention low market value. I think you guys can run any analysis you want. If you look at that, our multiples versus peers versus cash flow versus whatever, very comfortable with the valuation, and that's why you've seen, us as a business buying back the stock, and both as senior leadership team buying in the market. And that's the end of the presentation. So I'll maybe open it up to questions.
All right, Joe, thank you very much for that. I'm curious, your revenues and your notes said higher revenues are driven by the fluoroscopy as well as physician reimbursement rates.
Yep.
So what does that exactly mean?
So that's a good question, because that was in our first quarter. So if you look at the numbers, right? So what happens is that every day of every month of of every week of every month of every year, my nursing costs go up. My hourly rates for my staff goes up. My hourly my rent expense goes up. Like these things are kind of constant, right? Like that per square foot number, right? Like, so if you say, if my medical supplies are going up, the nursing costs go up. What happens is that government reimbursement for procedure fees also goes up over time, right? So doctors don't make less in 2025 than they made in 2020. And so as those change, because the way we bill the government for those fee codes, they flow through. The thing is that I don't want to overcomplexify, but there's like mountains of fee codes that doctors can bill for various procedures, right? And there would be, I don't want to say dozens, maybe hundreds of fee codes that our doctors may use throughout our system. Some go up, some go down, but over time they generally move, but they move stepwise. So I may have nursing costs go up, and it may take a year or two for the government to catch up and have a new agreement with doctors. So what we noted there was just in particular that we've had some adjustments that are reflective of more, call them COLA adjustments for doctors, that are catching up to some of the costs. So you'll see my costs will rise, and then I'll have no changes in government fees. And then so I'm hovering. And that's why you see my margins, like I'm still improving, but not as fast as people would like. And then you'll see a step up, because these things will happen. And then the government will step up and my costs will keep going. And then the government will step up and my costs will keep going. And so you'll see this kind of bounce around. So I think the long-term trend is that both go up together. They just may take steps. So Q1, we had some adjustments to the fee codes that we use that have helped catch us up, because we were fighting against the old codes with our cost structure, right?
Yeah. And I guess the government can't really, where Canada's suffering from lack of people. So the government can't really be cheaping out too much on that, because they need to keep prices or fees paid to professionals inflation adjusted, so they keep as many
They will
people
at
in the
least
industry.
inflation adjust. Yeah. So
Yeah.
I mean, at the end of the day, they want to. There are occasionally times where they say, well, this fee code's too high and this one's too low, and they'll play around with that. But on the basket as a whole, what a GP made 10 years ago and what they make today and what they make 10 years from now will go up with the inflation, right? And so they do adjust those over time. But they can move around, but the whole basket as a whole generally moves up. Right.
Okay. All right. I'm curious with since we're talking about staffing and that, there's been some headlines in the general media about U.S. healthcare workers wanting to come up to Canada. Are you seeing any evidence of that?
So the short answer is no. I mean, there's in terms of, well, let's talk about physicians first. We've had anecdotally heard that from recruiters that they're seeing a large number of interest from U.S. doctors, right? And so, when you talk to these recruiters, I know one of my competitors, we tend to be friendly competitors, but one of my competitors has noted that, for a position they posted, they have, multiples of what they used to get in terms of interest, and largely from south of the border. So, that's kind of a anecdotal piece. On the nursing and other side, I haven't seen that yet. The thing is that so I haven't seen that yet on the nurse and other staff. If you think of our staffing, we have about 100 physicians. I probably have a similar number if you think about nurses. And then I have medical office assistants. So, they'd be, trained administrative professionals, right? So that's kind of where those three buckets are the main piece. The other piece that's kind of a harder one to manage is the whole radiation technologists. So radiation, because we have fluoroscopy suites that run, real-time X-ray, the radiation techs are in very short supply, and that's the one where probably there's a bit of strain on the system. But no, we're not yet seeing the U.S., although we're seeing the leading indicator of that, which is the recruiters and competitors seeing people kind of knock, knock, knock. Hey, are you interested?
You talked about, you've obviously gotten a lot of leverage as you've optimized your leasing, your square footage leased. Is there, you made some mention of it, but just to clarify that, do you still have a lot of square footage falling off lease over the next 12 months that still has an impact, or are you largely done with that lease rent optimization?
Yeah, so I had in slide 8 of my presentation, I talked about that where I was kind of going, you could see that really by the end of 2025 is where I expect kind of that flatlining piece on my existing network, right? Like if I buy something new, that's different, right?
Yeah.
But if I say my existing network, we're going to be down to about 68,000 by year end. But
Okay.
when I say that my network is down, Windsor and Brampton are growing, right? So
Yeah.
that's my net decline, right? So I have some of the facilities that are dropping faster, some that are growing, and the combination of the two means a net effect. So that's the net, is the 25,000 square feet that have dropped out from 23 to the end of 25. So that's what you really see that in 26, the full net impact of the growth in the two clinics and the
Yeah.
decline in the others.
Does the square footage utilization, that's not part of your overall capacity utilization metric, is it? That's more of like sort of hours booked and
Well,
that,
no, our
or
capacity, when we look at capacity utilization, it's probably closer to what you said. It's more related to revenue potential of a site, right? And
yeah,
so when we look at it that way, it's the easiest way to describe it is kind of look at that in that way. And we have different ways to look at that, but even that's kind of, it can be a little bit confusing. I don't want to confuse you too much, but let's say I have a 4,000 square foot site, and
yeah,
let's say I have 8 treatment rooms and 2 storage rooms, and I convert a storage room into a treatment room. Then I have
yeah,
9 treatment rooms. So I now have more capacity, even though my square footage hasn't changed at all. So there's a little bit of, we think about it more of a better way to think is more theoretical revenue potential of a site.
yeah.
And like what it does also is like some of our sites, like Brampton, we're open on Saturdays and evenings. So they're operating at above 100%
Okay.
in our calculation, right? So it's kind of
Yeah.
you have to think about it. It's a little bit, it's sort of more on a Monday to Friday theoretical revenue potential.
And you sort of answered it a bit. You like one facility is running over 100%. How high, or how what would you like to get your capacity utilization to generally over the network? I don't know if you getting
Yeah,
too high then sort of bungles things up a bit. Like where would you like to be?
I always say roughly at 80%, I start to run into problems in the sense of not scheduling, but in terms of recruiting. If I
Okay.
try and recruit a doctor and I say, well, you can have Saturday afternoon, most doctors will say, well, I kind of like my family, right? And
Yeah.
so that's where the challenge is. So you have to kind of have enough slack in the system that you could absorb new people into the network.
All right. I'd like to switch over to the balance sheet side. You just announced recently a 13.5 million credit facility, and you've sort of swapped out your old one. Uh, I guess overall over the last 3 years, how have your, let's say, interest or finance fees have they declined substantially, or just on a percentage basis, or your overall debt's down? So obviously you're paying less interest. So can you just
No,
talk about that?
no. So let's talk about the interest expense here. What we've had is we had 3 different pieces. We had in our former debt structure, we had 3.6 million of basically founder debt that was interest free. Now,
Okay.
one can imagine a world where people would take 100-year interest free loans, but they don't usually do that. So at some point, that had to be retired. And that was probably 7 years old, right? Then we had, that tells you that as a shareholder, Bloom Burton's been very friendly and supportive of the business. The Then we had I would call it was kind of debt that we did at a more distressed time in the company's history, where we did 10% debentures. But if you do 10% debentures with 10% bonus shares, your actual interest expense, as from an accounting perspective, is well above 10%. It's more like in the 20s, right? When you put in all the fees, et cetera. So I had kind of the 0% debt. I had debt that was probably in the 20, effectively, the effective interest was about 20s. And then I had my RBC debt, which was prime plus. And now I've folded those other things all into one piece that's at prime plus. And so I would say that for a business like mine at 75 million revenue with interest expense below 6%, I mean, I'd say we've grown up, and that's kind of what we wanted, right? So we have 6.5 million term debt that is 10-year term, so it's really friendly to the company. So we're very happy with that. And the interest rate is, like I said, it obviously will depend on prime, but as of today, below 6%. I think rejigging all that and coming out with, you have, I don't want to call it, I guess, distressed debt would be kind of a thing, because it's kind of the pricing of that was in a terrible market when no one wanted to invest in the company. And, founder debt at no interest. And then now we got a proper bank facility. We got a credit line, which ultimately will allow us to run on lower cash balance, right? That frees up some cash that we can use, for your day-to-day fluctuations and your payments in and out. You have your term debt, and then you have your acquisition line. And so that's what we need, right? So as long as my cost of capital is, from an equity perspective, cost of equity is too high, having 6%, or low, mid-single digit interest on an acquisition line is the best way for me to take my cash flows and my acquisition line. I can at least deploy that into some smaller tuck-in transactions.
All right. How much capacity do you have there for acquisitions?
Roughly speaking, if you say that if you look at our cash balance, right, we had over 4 million at the end of the quarter, and the acquisition line, we have between 5 and 10, roughly speaking, of capital. But I think the better message that I'd like to give to people is, that's the line that we have. But
Yeah.
we have a partnership now with National Bank that wants us to grow, and they would like to see that the debt facility and their partnership with us grow, and they would like to see us roll up individual clinics, and they would like to be part of that. So I think I view them as, there's a piece of paper which says we have $3 million in acquisition line, but it's really more the partnership that we have with National Bank that wants to see us grow.
You mentioned earlier that NeuPath is right now trading at a less expensive rate than it would be for you to acquire standalone clinics. What is the going metric you see, or the range that acquisitions in your space go for?
So I would say for like because our clinics are specialist clinics, like, so if you look at, sometimes you'll see competitors or other players in the market talk about 3 to 5 times, but that's for family practice type operations where the billing is quite different than what we do in terms of interventional pain. So when you look at specialty clinics, you're probably paying a little more. So I would say 4 to 5 times would be kind of somebody who's doing, I would say someone who's in a market that we're already in and is doing kind of the same thing we're doing. If someone had a more specialized clinic that was providing more advanced procedures, was in a market that we weren't in, you'd probably be at 5 to 7. So let's say the first clinic I buy in province X that I'm not in yet will be more than 5 times. The second and third and fourth will probably be less, right? And so that's kind of the way I would think about it. And we did that in Alberta, and I think you'll see that elsewhere. So I think the problem is that, so with my shares trading at below those multiples, it means that issuing equity at these levels to buy things is not practical. So we'll use our credit lines and our cash flows to make some acquisitions, and then people see the organic and inorganic accelerate, and then hopefully we'll have a better piece of paper to use.
I was thinking I believe it's your Red Deer operations that are a 50-50 joint partnership with the doctors, I presume, that are operating it. To me, is that maybe an ideal or a very good growth model for you, where the doctors get to sort of keep some skin in the game, but then offload the management headache, and they're still partners and they're not just employees? Would you imagine a lot of your upcoming growth being in that joint venture sort of 50-50 model?
Well, certainly I'd say that two of the last three things I was looking at, we've talked about a 50-50 venture, kind of thing. So yeah, I guess if I think to the more recent conversations that's been part of it. I think at the end of the day, it's how do you bring people in to feel the part of something, whether it's employees, whether it's physicians, et cetera. And certainly we like that model because we know that it worked really well. And so being able to replicate that in other markets and in other potentially other provinces would be ideal. So yeah, no, I like that partnership model a lot. For our existing doctors, we've issued options to all our doctors. Um, so that's one way to kind of, bring them, a sense of being part of this. And then, separately, we've, like I said, this one's joint venture. I wouldn't be surprised to see more of those happen in future deals.
Like all things being equal, you have to wait for opportunities. Where would you ideally like to sort of open your next clinic? Would that be in a Calgary or just somewhere new like BC, or just what are your kind of all things being equal kind of preferences?
Yes.
All right. Okay.
Yeah, no, all the above.
All right.
Yeah, no, I'm not greedy. No, definitely we'd like to, I think we've got a good catchment in Ontario in the
Yeah.
sense of there aren't many locations that patients can't drive or come to visit one of our clinics. So we think we're pretty good there. I think Alberta, BC, Quebec, those will all be places we like to look at.
Right. You talked about growth potential in sort of new adjacent areas like orthopedics, I believe, and interventional radiology. Uh,
Yeah.
Would those be services you would provide from existing clinics, existing real estate, or would that require sort of new sites and new leases to open up those services?
Yeah. So when I say that, what I mean to say is that if I was to buy, and so I said interventional radiology. What I meant is radiology in the sense of, imaging. If most of my patients probably have had some sort of imaging done on them, right? So internalizing some of that so that it's more convenient for them would make some sense. So that would be new sites. The other thing is with radiology is that, for example, I know a radiology clinic where a specialist was doing some interventional pain injections in the radiology clinic. So that radiology would be doing X-rays for one reason, and then the next day they'd be doing pain injections, right? So I think that there is some synergy there, both in terms of the better servicing patients and as well better use of the facilities. So radiology would certainly be that would be to probably to new locations. If I was looking at orthopedics, would there be an orthopedics group that we would look at? There was a group that was doing, there were a group of orthopedic surgeons that were also doing some pain in a certain market. And, we talked to them about potentially bringing them on board. And, that would be kind of like it was a natural fit because they were doing some of their business was surgical and some of their business was pain medicine. And that makes sense to us. So that would be more likely that we would do those in new locations versus at like I wouldn't hire a surgeon to work in my one of my Ontario clinics, for example. It wouldn't make much sense. Not today. Yeah.
But you do you do sort of adjacent other services like massage therapy or physio, acupuncture, things like that? And is there an opportunity to do add those types of services?
So a couple things. Yeah, we own 10% of two physiotherapy clinics in Alberta. We inherited that back in when we acquired Health Point, but we own 10% of those clinics. And the reason we do that is because our doctors in Edmonton, they co-assess patients with the physio. So when a patient comes in with chronic pain, they'll bring in a physiotherapist to help them do the assessment. So definitely that's a logical thing. We have in one of our Ontario, Toronto area clinics, we have a massage therapist who comes in. I have one of my doctors in one of my cities. He's also does acupuncture for some of his patients. So, he's trained in that. So we do offer some of this, but not in a broad and formal way as of today.
All right.
I
I
think there would be, that would be something that we would like to. Um, the question is it better for me to, for example, hire a physio to work in one of my clinics, or is it better for me to have a partnership with a close by physio clinic and we cross refer? That's still do I need to internalize that piece Is it something that I want to work with? So anyway, it's kind of, there's different ways to look at that. So I think for now, we haven't looked at internalizing the allied care to a systematic way, but we do have certain doctors that have internalized that already in their practices, and we're looking at ways to do more of that. So I think if you look at us 2 years, we'll be doing more of that.
Question here from the audience. How much do you receive per treatment for the new injection, the arthrosamide?
Yeah,
Can
the
you comment on that?
arthrosamid, um, I don't have the exact price in front of me for what we're charging patients, but it's over $4,000 per injection. So if you go in for one knee,
Yeah.
that's a cost that either your private your private insurance would have to pay, or your individual have to pay themselves.
Yeah. And is that a one-time injection, or you go back every year or every 6 months
Well,
or
see,
so?
that's the key difference, is that like there are other treatments, like if you think for knee, people may be familiar who have knee problems. You may go in for hyaluronic acid injections, or you may go for PRP injections.
Yeah.
Those tend to be repeat. The number of repetitions is different, but this is a one and done.
Oh, wow. Okay.
So the company that got this done, it is an injectable hydrogel that forms a permanent implant. Yeah, so the injection, because it forms like, it's this hydrogel forms like a permanent, almost like rubber, like a permanent rubber implant in there. This is the best way to describe it. And so it incorporates into the tissue, and it's essentially permanent. We don't have 20, 40-year data on it, but I know that they have data definitely for a large number of patients over 3 years, right? And it's not absorbable into the skin. It's more like a silicone implant, whether they might use for, say, it's not the same material, but it would be, if you think about the concept of in plastic surgery, where there would be implants, for various procedures.
Okay. Well, that's a great option to know about for deferring, or at least before you can get your knee implants to deal with that.
Yeah.
Um, I guess we're almost wrapping up here. I'm running out of questions. Stephen Lemieux, who's joined as president, could you just talk a little bit about your roles versus his roles, and what does that maybe signal for investors, that you've got more bandwidth to pursue acquisitions or expansion, or sort of optimize more? Can you flesh that out a bit more?
Sure. So, there's definitely a lot, in our variety of business units. So on our clinic side, our clinics business, which is about over 90% of revenues, um, the uh, the what was I going to say? On the clinics business side, the operations piece, in terms of looking at, you know, um, the operation of the clinic underlying, and all the little pieces that go into our margins. Certainly, his previous experience with the company and his accounting experience will help us in terms of optimizing those, both existing clinics, but also as we bring things in and being able to optimize. So after you purchase them and make them, integrate them, make them a success. Um, we also have, so that's where I see him more on the as kind of an extent of my business development piece, because that's one hat I wear, is meeting with various clinic owners, and chatting with them about their futures and how they'd like to work with us. Stephen will help me on that side. So it's definitely bandwidth there. On the operational side, continuous improvement, getting us that 8 to 10% margins, over the next 2 years, getting this kind of improving the business overall. And that's really kind of what it's meant to signal. Is kind of, you know, I gave him the title president to kind of give him that kind of, a little more broadband. But I mean, we also have, as I said to one of the investors today I spoke with, we have about 14 subsidiaries. We should be at about 6. That requires some heavy lifting on the on organizational side, but will lead to cost savings for the business down the road. So there's in clinic level, there's corporate level, there's new systems we want to integrate, whether it's newer technology. So there's a whole raft of things that we're going to help. So he's going to be the person who's going to help me out on that.
Joe, I think we've covered everything that I can think of here. Any final comments or thoughts to leave viewers with before we wrap it up?
No, listen, I just want to say to everyone, I view us as an essential service for Canadians and Canadian patients. I'm very, to see, people coming into our clinic and laughing with the doctors is kind of a great thing to see. And, we take care of a lot of people every day, and, we're really happy to be able to provide this service to Canadians. And I want people to know I provide Canadian doctors to Canadian patients paid for by the Canadian government using paying Canadian rent and paying Canadian dollar staffing costs. So we don't, all the fluctuations in currencies and tariffs are completely unimpacted to us. We are somewhat insulated from all that noise, and we just focus on providing great care. So I think that the two little things I wanted to leave with people is just excited to be serving Canadian patients, and grateful that the storm around us doesn't touch us.
All right, Joe, thank you very much for the update and presentation and the last quarter solid results. Have a great day and talk to you again soon.
Thanks, everyone.